financing. A few owner-occupied homes in the U.S. are bought with cash. The majority of these homes are bought with loans, so we need to understand the lending industry. From home affordability, requirements to buy a home, and whether the investment itself is manageable. Now, before showing any properties, a licensee should do what? Refer a buyer to a lender for pre-approval. I want you guys to remember this sentence forever. Forever, as long as you're licensed, and even when you're not licensed, let's say you are the buyer, or even if you are the seller, you should always ask the buyer's agent, is your client pre-approved, right? So before showing any properties, you should refer a buyer to a lender for pre-approval. Why should we do this? To not waste time. Whose time? Everybody's. Very good. So a lot of buyers, especially the wannabe investors, they're funny. They're like, look, I got the money, I'm approved, I got a great job, whatever. Just can we go see houses? I'm like, okay, we can go see houses, but unfortunately, I need to know exactly how much you qualify for, because if I find a house that you like, let's say 500,000, right? But then for some reason, there's something in your finances, hey, not judging, but there might be something in your finances that say you only approved to 480. How are we going to buy this house, right? So think of it as going to a restaurant. I'm not doubting that you cannot afford the meal at the restaurant, but just to make sure, is your credit card working? Just to make sure you have cash reserves to pay for that bill in case the credit card doesn't work. Because it has happened to me where I have credit card with a bunch of credit limits, and then for like $50 that I'm paying for a meal, it doesn't work. And here I am embarrassed with my client that my client is paying for it because I didn't have cash with me, right? So very embarrassing, right? Luckily, I got on the phone right away with the credit card company as we were doing this, but then the client had already paid for it. And they go like, no, you have your limits, is great, the card should be good. They had to send me a new card. There was something going on with it. So that's what it is. A pre-approval is just making sure that you can get to the restaurant, sit down, eat, and be able to pay, right? The other thing is, before we look at the menu, right? You're not going to look at the menu, right, without knowing if you have money. I know which types of restaurants I can go to based on how my finances are this month. You know what I'm saying? So we have to know. So Mr. and Mrs. Buyer, it is very important you get pre-approved before anything else, right? There's a lot of other reasons for this as well. The pre-approval will also show you the affordability. Will also give you an idea of how much your monthly payment would be. So wouldn't you like to know that, Mr. Buyer? Right? So these are some ways to deflect the, hey, let's go see houses because I got the money, I qualify for sure. Right? So just some ways to deflect that. A lot of buyers don't want to see first and then look for funding. All right, so real estate professionals must be knowledgeable about financing programs and products to provide quality service to buyers and to be able to help buyers make realistic goals about the type and amount of financing that they can obtain. Now, importance of understanding housing affordability. Congress, state legislators, and local governments are always looking on ways to make housing affordable. Creative financing, low interest loans, interest-only loans, flexible lending standards help expand the housing loans to borrowers who otherwise wouldn't have qualified. Now, real estate market cycles and recessions show us that financial education is key. Following the market crash of 2008, many borrowers defaulted and record foreclosures drove down real estate prices. Even since then, we saw sales and property values increases. Many forgot to go back to the basics. So as this book is being written, we see history repeating itself. When are we just talking about it? All right. It's like people forget that mistake, right? So it's just a fact that not everyone should own a home, right? As homeownership is not only a big commitment and responsibility, but also a budgeting act. I was going to write juggling act because that's what it is. For some people, it is juggling. Like today, I got to pay the electrical bill. I might not be able to pay the mortgage, but we can delay a few more days. Now it's the car. Now it's the credit card. And I'm like, oh, I only got like $1 extra this this week, So we make choices. It's a juggling act for a lot of people, right? So it must be fully understood to prevent the loss of a home or an investment property. Renting for some people might be a better option, especially for people whose jobs require frequent moves or those whose finances are uncertain. A lot of, see, that's one of the things that I did talk to you guys the other day, that when somebody applies for a rental, I always try to see if they qualify to purchase a home, right? One thing is checking in with them and seeing if they can purchase a home. Another thing is what a lot of agents do. Why rent? Buy. Like, it's not why rent is, if you don't need to rent, buy. You know what I'm saying? It's not like, why rent? Stop renting now. Or some advertisements out there is like, why rent? 3.5% down can get you into a house. Great. And then you forget there's other costs. And we're going to talk about that too. It's not just the 3.5% down, there's other costs. Technically, you got to be ready with anywhere between 5 to 7% because of closing costs and everything. So don't advertise something that most people won't qualify. And when I say most people, when I say most people, is because the majority of the United States falls under poverty guidelines. So it is sad, right? So if the majority of the United States is under poverty guidelines, can they afford housing as a rental or as a purchase? That's the determination that you're going to have to establish. Zoraida says bankers do that. Everybody does that, of course. Look, bankers do that, mortgage professionals do that. We do that all the time. I just think it's wrong the way we say it. So we need to start, and I'm including myself, we need to start correcting the way we say things. Because people, I don't know if you guys remember, we have this chapter 9, agency. People rely on us as professionals to guide them, right? Some of you have knowledge already of some of the stuff that we're going over here, right? Some of you don't. So it's my job to do what? Educate you guys properly, right? And hopefully I educate it in a way that you can relay that message to the people that you know. That's my job. Your job is to be able to relay the message. So depending on where you're going to go work, the marketing strategies are very questionable, right? Marketing strategies, like I said, hey, it's only 3.5% down. Don't rent anymore. Buy a house now. Not everybody qualifies. How about finding out if you qualify? Let's find out if you qualify. Let's get you into a home buyers seminar that will answer all your questions and see if you can qualify. You know what I'm saying? Not like, hey, don't worry about it. You got 3.5 down. Let's do this.
Get ready.
Get ready. Yeah. And then you go from a $1,500 rental to a $4,000 mortgage that you can never afford. So that's why we need to do pre-approvals. That's why we need to go over all this information. So renting also frees the tenants from management and maintenance. That's another thing. People don't know this. They're all in the illusion of wanting to buy a house, and then they're like, oh, wait a minute. I need to fix this. I need to fix that. I used to have somebody do that for me, right? So buying or renting a property involves considering the following factors: how long an individual wants to live in a particular area, a person's financial situation, housing affordability, current mortgage interest rates, tax consequences of owning versus renting property, and what might happen to home rates and tax laws in the future. Because yeah, these are constantly changing. Even the tax laws are constantly changing. Like a lot of, I love investing because it's like a business. So there's a lot of favor to those type of purchases. Okay, where if you are a single residential homeowner, like your single family where you live, you don't have many benefits when it comes to taxes. So these are things that you need to know. And then home rates. About 15 years ago, the home rates were around 8-9%, and people are complaining about being at 6% right now. Like, yeah, we were way worse. You know what? Back in the late 70s, early 80s, we were at 23%. You know what I'm saying? And then people are like, oh, but the house prices back then. There were still $500,000 houses. There were still $1 million houses, and people were still paying 23%. Higher down payment still. Different type of budgeting education back then. Things became so easy nowadays when it comes to credit, became so easy nowadays that people don't know how to budget, right? In fact, I'm sure some of you guys here got out of college straight into debt. That's the first thing that you learn in the United States is how to get in debt versus how to establish yourself so you don't get into that. Or if you do get into that, which is great, Rich Dad, Poor Dad, by the way, if you read that book or listen to it. If you get into good debt, make sure you manage it properly. Okay. Oh no, Stephen, what I meant was this is not in New Jersey. This is nationwide IRS. What I meant was it doesn't see it as favorable, so you don't get as many benefits. The only thing as a single homeowner that you can deduct is mortgage interest. So any interest that you pay on the loan is tax deductible, right? For your car, for for single family. If it's no. Mortgage interest is tax deductible. Mortgage interest is the only thing. We're going to go over that as well. It's the only thing that's tax deductible for a homeowner. If it's an investment, if it's a business, then you have other things. You can deduct other things, the repairs. We'll talk about it also in a different chapter, but you can deduct the repairs of the house. You can deduct the interest as well. And then there's just a bunch of other benefits because they treat it as a business versus your home. Okay, it's the same. Think of it this way: being a residential homeowner is like being W-2. You're very limited on what you can deduct. Okay, when you have investment properties, like being 1099, there's a lot more options to deduct. Okay, because it's like a contribution to society. Yep. All right. So recent history and availability of certain types of loans demonstrated that some people engage in mortgage fraud by inflating their income or assets, reducing or hiding their debt, or even giving false employment history. Weren't we just talking about this too? Right? These types of loans are coming back. You can say whatever you want, right? I got the announcement last week and I got an email today. The announcement last week goes like, oh, Bruno, do you know you just need, if you're self-employed, all you need is CPA prepared profit and loss. That's it. We don't check anything else. I'm like, wait, no more bank statements? So technically I can pay my CPA to put whatever I want there? Well, you're not supposed to tell me that. I'm like, I'm not supposed to. I'm just telling you what's going to happen. There's a lot of people that will just tell the CPA, right? Some of them don't even have CPA. They just have like a tax preparer with a preparer ID, which allows them to do these P&Ls or profit and losses. So there you go.
Doesn't that like hurt them? They get a
Okay, hold on. It hurts them, but also benefits. When you're in business, you know that sometimes your investment will hurt you immediately, right? But benefit in the long run, or it will benefit you immediately, but hurt you in the long run. So again, it goes back to that juggling or balancing act, which you must decide, should I invest in this now this way, or should I invest in later? There's a lot of people that don't care. So the same way as those businesses that work cash only, or the majority of their income is cash. Do you think they account for everything when they do their taxes? They don't. But in the long run, it hurts them if they want to get loans. If I don't state to the IRS that I've made $10 million, right? Let's say in cash, and I'm only stating that I made 2 million in credit cards or anything like that, right? Then what is my net worth? This will be based on the 2 million, exactly, right? So now when I go apply for a loan, and this happens a lot, guys, you're gonna get so frustrated, just giving you a heads up, so frustrated when you deal with business owners, because they say, no, I make enough money, I make like more than a quarter million a year. And then you see their tax returns, $47,000, true stories, $47,000. I'm like, I thought you said $250,000. Well, I can't show everything. Well, you need to show everything when you go apply for a loan, because they go based on that, right? So anyway, So that's what it is. They either inflate their assets or reduce or hide stuff. So it becomes really bad for them, right? But there's also something called predatory lending. What do you think predatory lending or being a predator means?
They probably try to focus their attention on people that are vulnerable, they really, really need the money. Lend it to them.
Key vulnerable place. So there's a predator and there's a
Prey.
prey. Okay. For you guys that don't know what this means, because sometimes English is a second language, there's a hunter, right? And a huntee. There you go. So what the bank is doing sometimes is taking advantage, right? And we'll talk about that later as well, usually, right? Take advantage of people that are vulnerable, right? The preys, right? And giving them loans that they would not qualify. So targeting people who are desperate. Absolutely. All right. So predatory lending also victimizes loan applicants with high fees and abusive interest rates. Now, several loan programs exist, but their availability is mainly related to the income and credit qualifications. And some government programs like FHA and VA usually come to the rescue with lower down payment and credit score requirements. So over the next 2 days, so today and tomorrow, we're going to go over all of this, including a loan application, what to look for. And again, guys, we're not the ones that do the loans, but having this basic understanding will help our clients be prepared for it, right? There's no point in wasting anybody's time. The more time you waste, the less money you make. Does that make sense? Okay. So homeownership expenses and affordability. Right now, I'm just going over some terminology that will help. So homeownership involves many costs, including utilities, maintenance, and repairs. Property taxes and insurance are also required costs that most of the time are included with the mortgage loan repayments. A payment that is PITI, whenever you see PITI means that principal, interest, taxes, and insurance are included in one single monthly payment. Some mortgages only have principal and interest, and you handle taxes and insurance on your own accord. So whenever the bill gets there, you pay for it. Some mortgages, you have to pay everything in one single monthly payment. It's like they don't trust you. All right. They're like, no. We will take care of it. They charge you an additional fee for that, and we'll talk about that later also. That goes into the APR, but they charge an additional fee to manage it for you, manage the taxes and insurance payment for you. Most mortgage lenders use a computerized underwriting system that considers not only the applicant's income, but also the credit report and credit score to determine the buyer's affordability. Now, many people think that they should get approved because they have qualifying credit score, right? We just talked about it as well. When in fact, the lender looks at various credit factors such as their income, credit history, and the number of credit accounts that they have currently open, their payment history, and usage. Most of this information is used to calculate what's called debt to income ratios, or DTI. So a few terms that we're going to go over. Again, how many times have you heard if you got a 620 score, right, and you got 3.5% down payment, you qualify to buy a house? No. I have people with 700 scores and they don't qualify to buy a house. 700 scores. Because when we look at how much they're spending on credit cards, right, yeah, they earn the 700s, but they're above a certain limit. So their DTI, or debt to income ratio, is too high. So now you don't qualify. This is why, again, financial education is key. Having your credit cards, for instance, below 30% usage is wise. Having one credit card loaded with everything and the other one's empty is no good either. All right. So across the board, all your credit cards should not be above 30%. If you can keep them below 10%, even better. Okay. Which sucks. Like, why would you give me $10,000 limit if I cannot use it? Right? You can just make sure, bring it down. Connie, so is it better to close your credit cards? Nope. If you close your credit cards, we're not going to get into a credit class right now. But yes, if you close your credit cards, it will affect your score because you're losing what's called credit history. Depending on how old that credit card is, it might be the best history you have. So I have a credit card, really bad one, by the way, in high interest rates. I use it, but I pay it off most of it. I just leave a little bit so they can feed as well, you know. But that credit card, really high interest rate, but it has over 12 years of history. You know what I'm saying? So I keep it. History. It's good. That's the only reason why I keep it. I use it like what I started doing after screwing up my credit royally, so you guys know. Young, dumb, and stupid. I did not know these things. I came from Portugal. We don't have access to credit cards like this. We do have credit cards, but not like, oh, I want a credit card approved. So after screwing up, I started realizing how this works. And of course, I learned from one of my mentors, use this credit card for this, that credit card for that. So I started allocating credit cards for different purposes for proper management. Don't use the credit card for everything. So I got one that's just for gas. That's all I use it for. And I manage it that way. I have one that I use for some utility bills. Does that make sense? So keeping it separate away. One that I use to go eat. I never use my debit card, by the way, only credit cards for several reasons, cashback, obviously, and also fraud protection. Debit card does not give you fraud protection, or most of them don't. So anyway, not getting into how to run your credit. I'm just trying to show you that if you manage it properly, you qualify. If not, then Steven says, come with 50% down and see how fast you qualify. Yeah, so that's like the trade-off, right? You might have to come up with more down payment because of your credit history and credit score. You might have to compensate somehow. Some loan officers will tell you though, hey, instead of me giving you 50% down, Steven, pay down some of your credit cards and let's revisit this in the next 2 weeks. All right, we can do a rapid rescoring. So it's like, let's move this. You still need a higher down payment based on what I see, but we can maybe get you in the better preferred rate or tiered rate than you are now. So there's a few things that you can do, and they'll do what's called rapid rescoring. Yeah. Yep. Zoraida says, I have a secured credit card with 10 years. It's the worst I have. Hey, it's history. Keep it. Nice, just travel points.
If you have a credit card and you don't use it at all.
Oh, if you don't, we're going into a credit class. If you don't use it, you lose it. You ever heard that expression? If you don't use it, you lose it.
Yeah.
See, creditors, they are in the business of. Connie said, sorry, did I not answer something? Are you saying sorry because you brought that topic?
Mhm.
Yeah. Yeah, it's your fault, Connie. That's it. That's it. Milton says bad credit is better than no credit. Yes. Anyway. Well, let me ask you something. If I would do, because I have a friend of mine that does credit education and repair and all that stuff. If I would do, since you guys brought it up, a Zoom class, completely separate from this, at a different time, different date. If I would do a Zoom class just on credit, would you guys attend? You would? Yes? Okay. So what I'll do is I'll talk to him, find out if he's available to do this, and explain better the options. Okay. This way we can move forward from here. And look, because it's not part of the 75 hours, what I would do is if you have any clients that you're looking to already work as soon as you get licensed in the 60-day challenge, right? What you can do, if they have questions, you can invite them. Friends, family members, invite them for that. I have no problem with that. It's not part of the 75. To this here, obviously you need to be registered and part of the class, but to that webinar, or we'll do it in person if you guys want as well. Doesn't matter.
Yeah.
Yeah, we got room. Yeah. We can fit 30 people here. So I'll ask him and see his availability, and then I'll let you guys know. All right, this way we don't waste more time in the credit. Anyway. Loan to value ratio. You guys ever heard this? LTV or loan to value ratio? Who has heard of it? Okay, 4 or 5 people. Okay. Loan to value ratio is the loan as a percentage of the property's purchase price. Okay. With a 10% down payments, the balance is the loan amount, and that represents the LTV, which in this case is 90%. So 100% purchase, 10% down payment. That means the loan to value, the maximum loan that they'll give you, is 90% of the purchase price. It's pretty much what it is. And that's because usually the purchase price is property's value. Okay, there are some situations where we buy it at discount, so we have more equity. There are situations where we have to pay to meet the difference because we bought it overpriced. Okay, so these are things you must remember. Traditionally, we pay for the value. Sometimes we got a discount, sometimes we overpaid, but the banks only lend up to 90% of what the value is. Okay. In this scenario, it could be 96.5. That means 3.5% down payment. It could be a program that's 25% down. So then 75% max on the loan. Okay. You go with that? Understood? Great. We'll do some more calculations tomorrow. We'll talk about DTI. We'll talk about LTV, how to do the calculations and help your clients understand it too. Mortgage loan terms. When a borrower gives a note promising to repay the borrowed money and executes a mortgage on the real estate for which the money is being borrowed as a security, the financing method is called mortgage financing. The term mortgage financing also applies to real estate loans secured by a deed of trust. We'll go over that later. And the process of securing a loan by pledging a property without giving up ownership of the property is called hypothecation. Let me address real quick. Hypothecation is I have a house, I have a car. I got a loan to buy it, right? And I get to use it while I'm paying the loan. Okay? So hypothecation is I got the loan for something. I gave up the property as security, as a collateral, but I'm still in control of the property and use of the property. Okay, that's called hypothecation. So back in the day, just to clear it out, before credit scores existed or became popular, a lot of people had to come up with either a substantial amount of deposits, so 40% and 50% down payments were normal, or the bank would be like, okay, what else you got? Well, I got a car, I got another house, I got gold, I got whatever. So you would use something as a collateral that you would give up to the bank. And once you finish paying it off, they would give it back, right? So that would be giving up ownership and possession of the property until you pay off the loan. You got it? So back in the day, it became more and more popular once the credit scores or credit system by Fair Isaac and Company came out, right? So the FICO scores became more and more popular that the lenders look at your credits and say, well, you're within this range, so you have to be responsible with your bills. Therefore, here's a loan and you get to keep the house. You got it?
But if you don't pay the loan, take it.
Absolutely. If you don't pay the loan, they can take it. So, but hypothecation, that's what it is. I don't know if anybody has a question on that, but hypothecation is you're getting the loan and the collateral until you pay it off. If you don't pay it off, yes, they'll take it from you. Good? All right. States differ in their interpretation of who owns the mortgage property. Those that regard the mortgage as a lien held by the mortgagee, the lender, against the property owned by the mortgagor, the borrower, are called lien theory states. Those that regard the mortgage document as a conveyance of ownership from the mortgagor to the mortgagee are called title theory states. Some states interpret ownership of mortgage property from a point of view that combines the aspects of both title and lien theory. We'll go over in detail about these as well. Now, a valid mortgage or trust deed financing arrangement requires two documents. There's two documents every time there's a purchase of a house that's financed. Two documents. Number one is the promissory note or bond. In some states, they call it bond. Okay, promissory note or bond. Now, what is the promissory note or bond? This is literally the promise to pay, or I owe you, right? If you've never heard I owe you, that's what it is. I owe you money. Like a check. A check is I owe you money, I promise it's in the bank, go cash it out. Right? I owe you. Which means it's the loan, which means it's the money. So promissory note literally represents the money being given in the transaction. Okay? Promissory note is the money being given in the transaction. Now, the other documents could be a mortgage or a deed of trust, depending on the state that you're in. Mortgage or deed of trust. New Jersey is mortgage. We're a lien theory state. So you have mortgage in lien theory states or deed of trust title theory states. So if it's a mortgage, let's figure out what the word mortgage means. Mort means death. Gage means pledge or grip. All right. Now it's not your death. It's a death of the loan. Because that's what dies every time you make a mortgage loan payment. Right? The loan starts dying down until it reaches zero, right? So death of the loan. Mortgage is a death grip that the bank has on your property that you've pledged as collateral or security. You pledge the property as collateral or security. Okay, remember that hypothecation? I said, give me the money. Here's the house in exchange, but let me keep it while I'm paying it. Just like your car, let me keep it while I'm paying it. If I don't pay, come repo it or foreclose on my property. Right? So the word mortgage is about represents the document that represents what? The house. All right. So with that being said, who gives you the money? The bank. Who gives the house? No. The owner, right? Or in this case, the borrower, who's about to become the owner. These two documents are signed at the same time, right? Together with the deed. So three things happen at the closing. We sign the promissory note, we sign the mortgage, and we sign the deed. Okay. One is for the transfer of title, the other one's to close the loan. So to close the title, close the loan. Okay. Now what's happening here is at the closing table, we're telling the lender, I give up my property in exchange for the money. I give up my property. So who's the mortgagor? Who's giving up? So the borrower, that's the mortgagor. So who's the mortgagee? The bank, the lender, receiving the property. Very good. You have to remember that stuff. So we had it here as well. Mortgagor is the borrower, right? Mortgagee is the lender, right? You guys remember I had a table that explained that too, right? Guarantor, grantee, lessor, lessee, mortgagor, mortgagee, right? So always remember that OR means owner. Mortgagor means owner, or whoever has the right to give up that item, whatever it is, okay? Now, deed of trust. If you're in a state that uses a deed of trust with financing of a house, then the title to the property goes to a third party while you're paying the beneficiary. So during the period of time that you're paying the lender, right? And we'll go over this in a little bit. While you're paying the lender, the beneficiary, right? Somebody else holds the title to the property. You're still the owner. You still pay, living there, using it, whatever, but you only get the title when you finish paying it off. So this becomes the beneficiary security that somebody else is holding the title, right? So in the previous one, there's a lien against the property and the house is the collateral. In this one, is the title to the property is deeded to a third party, unrelated, right? So it could be a title company, for instance, or an attorney. Now, here's what happens. When you finish paying it off, there's something called reconveyance deed. So the, and again, guys, we're gonna go over all this. We're just laying out the grounds for what we're gonna learn. Reconveyance, what does the word conveyance mean? Transfer, right? So reconveyance means to retransfer. So we transferred to the trustee, the trustor to the trustee, right? And once we finish paying off the beneficiary, the trustee transfers back to the trustor, reconveys or transfers back to the trustor. We're good? All right. Guys, you have to be on camera. I need to be able to see you. If you're not on camera, I will terminate your session. Promissory note. A promissory note, or sometimes called bonds, is the financial instrument signed by the borrower who states, I pledge to repay the money you have just lent me at the following interest rate and terms. The note makes the borrower personally liable for the whole loan amount, regardless of the property's depreciation and value. By the way, this is there for a reason. I used to do foreclosure defense, so loan modification, short sales, whatever was needed back then, back in 2009 and on. I think until 2014 is when we stopped doing it. So for 5 years, that was my business. We were helping people not to lose their homes as much as we could, right? What happened was a lot of properties were underwater, as we'll talk about later. Underwater meaning the property was worth less than what they owed the bank, right? So in loan modifications, they're like, it's a restructure of the loan. So here we are restructuring the loan for the person. Now the person is paying less monthly payment, but the bill is based on a future payment. The bill is higher than what the property is worth. And some of the clients were like, Bruno, property's not worth that much. Why should I accept it? They should lower the value. And I have to counter it. I understand your frustration, but if you buy a house for 100,000 and appreciates to 500,000, are you going to give 400 to the bank? You're not. So you are liable for the whole loan amount, regardless of the property depreciating. Does that make sense? So the banks, even though some banks, because of government programs back then, some banks were forgiving a portion of the debt, okay? A lot of banks were not. So people were stuck with a whole amount plus late fees, plus late payments, plus attorney fees, plus processing fees, plus whatever. So they owed way more than what they borrowed. Okay.
If you're never late on a payment, you still pay interest.
So we'll talk about interest as well. Yeah. It doesn't work like credit cards.
Okay.
Okay. So the amount of the loan is typically the difference between the purchase price and the down payment. We already covered that. And the note establishes a personal responsibility. Mortgage. The mortgage itself is a security instrument signed by the borrower, which states, if I don't keep my promise to repay you as agreed, you may do what? Lender, you may foreclose, okay? So the borrower, mortgagor, pledges the ownership interests in the real estate in question to the lender as collateral while paying off the debt obligation. This document establishes a lien against the property. Trust deed. A trust deed or deed of trust transfers the property's title from the borrower, trustor, to the trustee as security for the loan. The trustee is a third-party fiduciary for the trust. What does the word fiduciary mean? Randy, since you're not on camera, what does fiduciary mean? I cannot see you. You always like, I see the walls. I don't see you. Ever. I'm gonna charge more for half faces. All right, fiduciary. Ashley says obligations. Okay, legal obligations, duties, right? You guys remember what those are? Can you give me some examples?
To act in the best interest of
To act in the best interest. But what are the duties and obligations that we have as a fiduciary?
care,
Care. Elizabeth wrote cold AC. What is it? Care, obedience,
loyalty,
loyalty, confidentiality. Very good. That's deceptive. Confidentiality, accounting. And we got care, obedience, and loyalty, right? Accounting, confidentiality. You guys forgot one because it's cold AC. So there's a letter missing. Elvira, thank you. Disclosure. Michelle goes dependability. Yeah, that goes with care. You got to care so much that they can depend on you. Yes. But it's disclosure. Disclosure. All right. So when you're fiduciary, there are certain legal obligations because they entrust you, right, and confide in you with their assets, property or assets, right? All right. The borrower receives the title from the trustee in the form of deed of reconveyance upon repayment of the debt. Next, we got financial components of a loan. Now, a loan is composed of several elements, and the basic understanding of these can greatly help a licensee when dealing with a buyer seeking advice or helping a buyer negotiate with a lender. First one. You guys saw this before already, right? This word, principal. What does this mean?
Client.
It means client. But we're talking about financing. We're talking about mortgages. So in this case, unfortunately, guys, remember I told you that interest for financing was different than interest in the property? Okay. Here, the same thing. Principal. And I apologize for an English language on behalf of the English language, where two words can mean 1,000 things. I mean, the same word could mean 1,000 things. Principal, when it comes to financing, no problem, Cheryl. Interest when it comes to financing is the original capital amount borrowed. Original capital amount borrowed. So principal is the $100,000 loan that I got to purchase the property after my down payment. Does that make sense? Principal is the total loan that I got at the beginning, on which interest payments are calculated. Now, in an amortizing loan, part of the principal is repaid periodically along with interest, so that the principal balance, it decreases over the life of the loan. So we borrow the 100,000, and as the years go by, it keeps on reducing until it reaches zero, hopefully. Right? We're going to talk about different loan structures, but if it's a fully amortizing loan, it reaches zero. At any point during the life of a mortgage loan, the remaining unpaid balance is called loan balance or remaining balance. Okay. So whenever you make payments to your mortgage loan, you're making principal and interest payments. So towards the principal amount borrowed and towards the interest for using the money. Because interest, to answer your question, interest is a charge for the use of a lender's money. So before I read the rest, Masha was asking, oh, but if you pay on time every time, you still pay interest. Unlike credit cards, where you can pay the balance for that month and be zero, right? Unlike credit cards, this interest is based on a 30-year usage of the bank's money, or a 15-year usage of the bank's money, or whatever we agree to as far as terms of usage of the bank's money. So to answer your question, the earlier you pay the full balance, the less interest you pay. You got it? But the interest is pre-calculated based on the whole term, where credit cards are based on 30 days. So at the end of 30 days, if there's a balance there, they charge you interest based on whatever the balance is. That's why you should pay it off, or as much as you can prior to the closing of the statement, not by the due date, by the closing of the statement. This way they calculate based on whatever's left, not based on the total amount that you still have there. Okay, so here's the same thing. You got 30 years, but if you pay off in 10, you saved 20 years of interest. Okay, calculated differently, but you get the idea. Now, according to the terms of the note, mortgage interest is commonly paid in arrears. That means at the end of the payment period. So if I borrowed money today, when do I pay the interest? 30 days from now. Okay, so it's always based on 30 days later. That's what the interest. So instead of upfront, it's in arrears. Only because the bank doesn't know if you're going to pay off the loan within a couple of days. So before the end of the term or the period. Now, interest rates. So there's interest, and then the interest has a rate, which is a percentage applied to the principal to determine an amount of interest due. The rate may be fixed for the term of the loan. That means it doesn't change, or it may be variable according to the terms of the note. A loan with a fixed interest is called a fixed rate loan, and the loan with a variable interest is commonly called adjustable rate loan. Okay, so we call these ARMs, adjustable rate mortgage, because it has a variable interest, it's adjustable interest. So you never know. It's like a surprise. You never know what your next payment's going to be.
Christmas, I mean.
It's like Christmas. Yeah, absolutely. Hopefully you don't get cold. All right, guys, make sure you're on camera. Make sure you're the only one on camera, not 1,000 people on camera. Michelle, like you paid for one, not for 1,000. I was going to say 300, but then it takes us back to Sparta, and we don't want that. So 1,000 sounds better. All right. Because of the interest rate on mortgage loans does not reflect the full cost of the loan to the borrower, federal law requires a lender on residential property to compute and disclose an annual percentage rate. We'll talk about this tomorrow, but APR is very important. That includes other finance charges in addition to the basic interest. So there's something called basic or pure interest. Like, let's say banks advertise, oh, buy this house with only 5% interest rate. That's great. But depending on the type of loan you get, there's other charges. If it's PITI, like I told you, you'll have a separate company to handle the escrow monies, right? That means whatever they receive with the money, with the payments, right? They put that money aside into a separate account. The usage of that account or the charges of that account are added to your loan. Somebody that will make the payments for you is getting paid to make those payments. So it's added to your loan. So APR is the true cost of financing. Again, okay, so right. Again, we'll talk about that tomorrow, but have an idea that interest rate and APR are two separate things. When you go shop around, you want the APR. I don't care about the interest. I want to know the APR. Okay, because from bank to bank, they could charge you 5% interest at Wells Fargo. We'll say this again tomorrow. 5% interest at Bank of America, but the APR at Wells Fargo could be 5.19, where Bank of America is 5.24. The basic interest is still 5%, but then the bank charges on top of the 5% change the true cost of the loan. This is why it's mandated, like we say here, federal law, right, requires the lender to disclose this because we're entitled to shop around for a better rate. Okay. All right, points. Again, still in terminology, a lot of stuff to learn here. Points. From the point of view of a lender or investor, the amount loaned in the mortgage loan is the lender's capital investment or major investment, right? The interest paid by the borrower is the return earned by the invested capital. It is often that the case that a lender needs to earn a greater return than the interest rate alone provides. For example, a lender may require additional yields on the low interest VA loan, which has an interest rate maximum. So what we're saying is, I will give you the money, Mr. or Mrs. Veteran, because that's what the VA is for, right? I will give you the money, but kind of hurts me because there's a max that they allow me to charge you, at least for the lifetime of the loan. So for us to keep it that low, right? And there's more reason to do this. I'll explain in a second. For us to keep it that low, we need to charge upfront an additional fee. Okay. So to get a greater yield on our money. So in such a case, the lender charges upfront discount points to make up the difference between the interest rate on the loan and the required return. This effectively raises the yield on the loan to the lender. Okay. So what is a discount point? This upfront discount point, what is it? Remember this, please pay attention, write it down, take notes. A discount point equals 1% of the loan amount, not the purchase price. 1% of the loan amount, not the purchase price, and is charged as prepaid interest. So when you see discount points, it's prepaid interest. Okay, so the lifetime of the loan, it was going to be 5% interest, which is equivalent to X amount of dollars, but you're going to get a 4 3/4, right? So the lender, to do the offset, might charge you upfront some money called prepaid interest. For instance, 3 discount points charged on a $100,000 loan would be $3,000, which is 100,000 times 3, or 100,000 times 0.03. Okay. Now, very important on this one, because there might be a question. If a house sells, still under the points, if a house sells for $100,000 and the borrower seeks $80,000 loan, each point will be 100, not 1,000. So the biggest mistake you guys make when it comes to points is you calculate the points based on the purchase price. Right here, this is the purchase price. While this is the loan amount. Okay, so the points are calculated based on the loan amount. So each point would be 100. Okay, got to make sure you remember that. It's 1% of the loan, not the purchase price. Good? All right. Now, the points in the new acquisition may be paid in cash at closing by the buyer, or of course by the seller on the buyer's behalf if it's negotiated by the parties, rather than being financed as part of the total loan amount. The borrower, however, must repay the full amount along with interest calculated on the full amount. As prepaid interest, points paid in this way may be deductible on the borrower's income tax return for the year of the purchase. Since it is a major expense that you're having right at the beginning, and it is interest, as we talked about before, if you're paying interest to a lender, interest is always tax deductible. So the borrower should seek what? Somebody qualified in that field. So CPA or tax consultant. We're good? We're done with points. The next thing we got is term. What is a term? And this sucks because we have term and we got terms. It just sucks. Sorry, guys. Vocabulary is going to be the biggest issue that we have. And then there's these things to confuse us. Principal means the same as principal, right? Interest means the same as interest. Term here has to do with time, but the terms of the loan is the principal, interest, and everything else, the clauses and all that stuff. So it sucks. And again, I apologize for the English language. Other languages also have this challenge, but this one's tough. So term here, when we talk about term by itself, we're talking about a period of time. So how long is this loan going to be for? It's pre-calculated to be for 30 years. So again, interest would be based on 30 years. It's pre-calculated to be 10 years. So the interest will be based on 10 years. Or you can have something called a 5-year balloon loan. It could be a 3-year balloon loan. It could be 1-year balloon loan. It could be whatever we establish. But what does this mean? This is a loan whose balance must be paid off at the end of 5 years, although its payments may be calculated on the term of another length. So it could be 15 or 30 years. Such loan is also sometimes called or described as a 30-year loan with a 5-year call. So that means we're going to calculate the payments based on 30 years. It's the same as a 30-year mortgage. But in 5 years from now, you have to refi or you have to sell the property or whatever it is. So a lot of construction loans are like that. A lot of hard money loans are like that, where you have 1 year to get out of this loan. I'll calculate it based on 30 years or based on 15 years or whatever, right? But you have 1 year to get out of it. Okay, that's a balloon. We'll define it better later on as well. Steven says, yikes. Yeah, I know. Payments. The loan term, the loan amount, and interest rate combine to determine the periodic payment amount. When these three quantities are known, it is possible to identify the periodic payments from a mortgage table or with a financial calculator. We have a mortgage table in this chapter. I'm going to show you how to use it because in the state exam, you have to know how to use it as well. Okay. No financial calculators in the state exam. I know you and Alexis were talking about that the other day, right? In the state exam, this is not allowed. Just a calculator. Do not cross it out. I'm just showing you, I'm just explaining something. When you go to the state exam, if you're doing from home, the program that you have to install or the browser you have to install in your computer has a calculator, very basic calculator, which is what you need. And if you go to the state exam, you used to be able to bring calculators, not anymore. Now they either provide you one there or they tell you to use the one on the computer. Okay. So that's it. You can no longer bring calculators. And it's a basic calculator. So you guys, those of you, which is 99.9% of us, those of you that are attached to your cell phone and cannot let go of your cell phone, you need to learn how to use one of these. You need to go back to basics. Okay? That's what it is. All right. So mortgage payments are usually made on a monthly basis. On an amortizing loan, a portion of the payment goes to repay the loan balance in advance, and a portion goes to payment of interest in arrears. Okay. If a borrower pays more than the scheduled payments amount, the excess is credited to repayment of the principal, which is reduced by the amount of the excess payment. The required minimum payment amount remains constant for the lifetime of the loan, but the loan term can be reduced by this means, thereby also reducing the total amount of interest paid over the lifetime of the loan. So that's what I was saying before. If you send more money, or if you prepay a portion or the whole loan, you pay less interest. You pay it faster, right? Which could be a good thing or a bad thing, depending on your financial goals, right? For some people, I see some people that get into 15-year mortgages. To me personally, that's crazy based on the way I see things. If I could have 100-year loans, I would have 100-year loans because I care about the lowest monthly payments and I use the difference to invest in other stuff. Some people, they just want to get rid of it, but then they have a high monthly obligation. So everybody's different, and that's something we need to understand when we give advice. My opinion, based on my goals, the longest term possible. Just be wise with the money. For some people, especially those that are really bad at budgeting, yeah, the quicker you get out of it, the better it is. The problem is if we don't have enough, the one who dies with the most debt wins. There you go. Absolutely. Rich dad, poor dad. Go ahead. You know, No, but there's, look, like I said, everybody's goal is different. I prefer to have a lower monthly payment and then get a fully loaded life insurance policy as an example, right? As example of an investment. So life insurance is a means of investment, which most people don't know. They just know, oh, life insurance is for when you die. No, there's great life insurance policies for when you live that you can borrow against, like a 401k or IRA, right? So anyway, not getting into that. Japan 99-year mortgages. I would love to have those here.
You should have a class, basically code. There's a code. Like, there's a lot of rules and a lot of.
Oh, there's a lot of stuff.
I would pay money to take that course. You know, you should think about it.
Yeah, well, we do have a couple things cooking, so we'll talk about it. All right, loan origination fees. Loan origination fee is a lender charge, not prepaid interest. So it's used to cover the cost of originating the loan, such as processing mortgage applications, the loan officer's salary, and other business costs. And you're like, oh, but don't they get paid already? Yeah. So they might get paid the loan origination fee. Okay, Lacey. They might get paid the loan origination fee from you, or they might get paid it from the lender. Okay, so whatever their salary is or their fees might be from one side or the other. There are strict regulations now about getting paid by both sides. So the only thing, and we'll also talk about that tomorrow, the only thing that we can charge is an application fee, but the loan officer's salary and any other costs could be limited to either borrower paid or lender paid. You cannot get paid from both. Okay, which was very popular during 2000s, the beginning of 2000 until the recession. It was very, very popular that they were charging you, charging the bank, charging your dog, charging the neighbor, charging everybody. Some of these lenders were making millions every single month, taking advantage of this system. That was stopped in 2009. All right, prepayment penalty. So we talked about this already. It's when you pay sooner than what you're projected to pay. So it's a charge for payment of any amount paid before it's due. The most common example is the seller paying the remainder of the mortgage so the seller can convey the property to the new buyer. Because when we get to the closing table, right, the new owner has its own mortgage. So what are we going to do? We have to pay off the previous to release the lien. So if I have a loan with Bank of America and let's say Nike is coming in with a loan from Wells Fargo, she's buying my house, I need to pay off Bank of America. Otherwise, the lien transfers to the new owner, not the debt obligation. If you guys remember, that's the promissory note. But the mortgage lien is against the house. It stays with the house. That's why we need to pay it off or satisfy it before transferring. So that will be a prepayment. So this causes the lender to receive less interest if the loan is repaid early. And for that reason, mortgage notes usually include a prepayment clause. Notice that I said includes a prepayment clause. I didn't say a prepayment charge, prepayment clause. So this clause requires the borrower to pay a prepayment penalty against the unearned interest portion for any early payments, typically in the first years of the loan, guaranteeing the lender a certain loan income. Now, prepayment penalties are not allowed on federally insured loans like FHA, or guaranteed mortgages like VA, or those sold on secondary mortgage market to Fannie Mae. So prepayment penalties are not allowed for any of these. And some states, we'll talk about it tomorrow, and some states might also prohibit prepayment penalty, like Jersey. Jersey says, I don't care what type of loan you have. You're not lending in New Jersey if you put prepayment clauses in your loan terms. Simple. If one of New Jerseyans wants to pay it earlier, they can do so at any time without any fees. Okay? Just remember, this is for commercial banking. A private lender might be different. Okay?
So prepayment policy is cheaper paying early.
Yeah. Because look, oh, so if you pay off the loan balance, remember you were asking me, what if you don't use your credit cards, right? There's another thing. If you always paying off the balance to zero, some creditors will say, well, if I'm not making money on you,
You're dead.
you're a deadbeat customer. So I'm going to charge you an annual fee to cover that, or I'll close the credit. Because I'm not required to extend credit. I gave it to you. But if I'm not making money out of it, not even 1 cent, I can close it down or charge you a yearly fee, like a renewal fee. Why? It's my money. Why would why?
You're using it because you need good credit, America. I don't even need
I know, but why would I give you the credit then? For me to make money. Speaking of that, usury. Have you ever heard this term before? Loan shark.
I think there's a place in the seventh circle of hell, an inferno for usurers.
Sorry. So
I'm not kidding. I'm so serious.
yes, since you brought that up, there's a place in hell for usurers. So here's the thing. Since you brought that up, every single religious book will tell you about finances. Every single one of them. This word is in every single book. Okay. Now, usury is when somebody uses and abuses. Okay. Uses and abuses in terms of charges. So usury is when a lender charges an interest rate that's excessive, that is higher than what the laws allows. Okay, usury, it's a higher or excessive charge. So use and abuse by the banks. That's what you got to remember. Use and abuse by the banks. Yep. Okay, usury. They're charging too much interest. Now, many states, not all of them, many states have passed laws that limit how much interest can be charged on loans to protect consumers from dishonest lenders. In some states, a lender who charges too much interest on the loan can still get the money back, but only at the legal interest rate. In other cases, check this one out, a lender who charges too much interest may lose the right to get any interest at all, or may lose both the interest and the whole loan amount. So if in some states, if the judge finds it to be an excessive interest, they'll slap the lender and say, hey, you knew you couldn't do this, right? So now as a punishment, you're not going to get anything at all. Not even the interest, not even the principal, nothing at all. Shame on you for lending and taking advantage of consumers like that, right? Now, a lot of things are changing, so you guys know, which is something that was always interesting to me as you know, being from another country. United States being a whole country, like I'm from the European Union, right? But it's a union, it's not a country. So each country has their own laws, right? Within the union agreements. Here it's the United States, but as a country. So you would assume that every state follows the same rules, but no. So not too long ago, we'll talk about this as well, the Consumer Financial Protection Bureau was created. The idea behind this is to start making these laws uniform across the board. So it's literally to protect the consumer from stuff like this. So some states allow usury, some states don't allow usury, some states limited an interest rate. You know, that's not fair. I should be able, and this is the 14th Amendment in the Constitution, I should be able to enjoy the same rights in New Jersey as I enjoy in California, and vice versa. So it's the same rights across the board. Constitution allows me that. Does that make sense? So having different laws in different states makes no sense. That's how sometimes we can use precedent cases from other states to defend your case in a different state. Anyway, Now, federal state laws that state usury laws don't apply to residential first mortgage loans that are part of a federally related transaction, which is when the federally chartered or insured lending institution or a federal government agency is involved in the transaction. State usury laws still apply to private lenders. So private lenders cannot charge above a certain amount, where federally related or chartered insured lending institutions are exempt from it, pretty much. Stephen says that's what the United States Supreme Court is for. True, but so but that's to appeal. It's different. We're talking about having regulations. So every state has their own regulations. Okay, every state has their own regulations. But if you're not happy, you can still bring it up to court. So that's a little different. What I'm trying to say is stabilize and uniform things across the board. Now, once it goes to all the way to the Supreme Court and whatever decision they make, it could become law, right? Or a rule that is set. So with any court, that's pretty much what it will be. But the Consumer Financial Protection Bureau, which started as a joke, actually, because the way they started was a joke, is now becoming is now having a stronger presence when it comes to this. So hopefully by next year, there's a few things they're supposed to come into law. Hopefully by next year, I'll have this part updated that shows that across the board, usury is not allowed. So it'll be the same across the board. That's one of the things. They already did that for when they slapped TD Bank for charging excessive penalties on the overdraft fees, right? They did that and made it uniform for all the banks. So that's what I'm saying. So it becomes uniform for everybody. All right, amortization charts. Let's go over these two and then we'll take a break. Amortization chart. So this will be on your exam. Almost guaranteed to be on your exam. So this chart shows us, guys, how to calculate your monthly payments. Okay, you guys ready to learn this? Exciting, right? Listen, you just need this for the state exam, because for everything else, I will move it. For everything else, there are apps on your phone. Like I use Zillow Mortgages. The only thing that's good out of Zillow is the app that they have to calculate mortgages, where you put all the info and tells you how much your payment is going to be. But for state exam, you need to know how to use this. Okay. So on the left of this chart, it says how to use this chart. You start by finding the appropriate interest rates, and then you follow that row over to the column for the appropriate loan term. This number is the payment required each month to amortize a loan. To calculate the principal interest payment, you multiply the payment by the number of thousands in the total loan. So here's an example. Let's say we have an interest rate at 6.25, so 6.25 for 30 years. The payment is 616. Let's confirm. The first thing you're going to do is find out, the rate. So we're at the column that says rate. We're going to scroll down to 6.25 or 6.25 right here. And then we're going to go to the right to 30 years. Okay, so we have here on top 10, 15, 20, 25, and 30. 30 is the last column right here, right? So 6.25 right here. And we're going to move 10, 15, right? 20, 25, and this is the 30. And it says 616 is the number needed to amortize the loan.
What is amortize? What is that?
So what does mort mean? No, that's mortgage, pledge of debt. But mort is debt. So to amortize a loan means to kill the loan slowly over time. Elvis, yes, the table will be on the exam. So if you go there physically, they now have it on the desk where you're going to take the exam. If you're doing online, sometimes it works, sometimes it doesn't work. I'm letting you know right now. There'll be a box they have to open. Okay, so I'm giving you a heads up. Sometimes it works, sometimes it doesn't. you do have a proctor, somebody overseeing your exam. If you cannot get this table when you do it online, and they will know because they have the error will pop up on their end, you have to let them know, hey, cannot answer this one because this and that, right? Cannot open or whatever the reason might be. And they shouldn't penalize you for that. All right, so we found out that 6 1/4 for 30 years is 616, right? Let's assume that the loan is $200,000. We're borrowing $200,000. How many thousands? Because this number is based on thousands, right? It's based on thousands. How many thousands do we have in 200,000? 200. Simple, right? There's 200 thousands. I know it's a stupid question, but I have to ask always. 200,000, there's 200s, right? Therefore, we're going to multiply the 200 because this number is per thousand, right? We're going to multiply 200 by 616, and our monthly payments of principal and interest only is 1,232. Principal and interest only. So I wrote it here again. Tax and insurance are not included in this payment calculation. All right. This is very important you guys know. Until recently, I don't know if you guys ever looked for properties on realtor.com or Zillow.com, but until recently, they would have an estimated payment for that loan, for that purchase. So if you were to buy the house, it would say, hey, buy this house, it's only going to be $1,232 a month. A lot of people will be like, Bruno, this is true story. This happened even with my cousin's father-in-law. Like, oh, that house I can afford. I'm like, no. This is just principal and interest. Now we need to go figure out how much the taxes are for this property and the insurance, estimated insurance for this property. Divide that by 12, add on to this payment, and that will be your payment. And he goes like, oh, okay. So then after I put that, we go from, let's say, 1,200, we go to 2,000. And it's like, oh, no. I'm not moving all the way down there, and I still have commute, I still have this, I still have that, and pay this much. No. All right. So very, very important. On the exam, will it specify the taxes, insurance include? Yes, it will actually give you, on the exam question, will give you the information. Okay. If there's taxes, all you have to do is divide by 12, unless it says it's monthly taxes of whatever. So they'll tell you right away. Samaya says, can you go over it again after the break? No, just tell me what you lost. Where did I lose you, Samaya? How to read the table. And that it's per thousands. Okay. This is how to calculate it. So if they told you, let's say they told you it was 5 3/4, then you'll identify where 5 3/4 are. And they'll say it's for 20 years. For 20 years, then the number is 703. House price is 350,000. I said 350,000. So it's 7.03 times 350, and that will be your principal and interest. If they told you that the taxes were $12,000 a year and the insurance was 1,200, well, 12,000 divided by 12 is what? 1,000, right? So now you add $1,000 to whatever your result was, and for insurance, 1,200 divided by 12 is 100. So you add that here as well.
Whatever the taxes.
Unless they tell you it's monthly. So that's another thing you need to pay attention in the state exam or in the school exam. Whenever you're looking at questions, you got to pay attention if they're saying monthly or annual. Okay, very, very important, because this number right here, it's a month per thousand. It's the payment per month per thousands. Okay. Samaya? You're good? Ask the question if you got a question. I just got one more thing to go over and then we take the break. But after the break, we go right into the next topic. So I just want to make sure you got it. Give me a yes in the chat if you got it. Give me a no if you didn't. Give me a maybe if you're like, unsure. I said in the chat. No, I'm saying you were giving the yes in the wrong.
Yeah, but how am I gonna get it again?
All right, got a bunch of yeses. It's okay to say no. Elvis says maybe with more examples. Shakira says maybe. Okay. All right, so real quick. We're going to do a quick exercise. Ready? Yes, Connie. Yep. You all right? Okay. So $350,000 loan, and it's at 4.75 interest for 25 years. Okay. The taxes, I'm going to put in a different color. The taxes are 10,800 yearly taxes. And the insurance is 1,350 yearly insurance. How much is the monthly PITI? So in the state exam, I'll translate what I just wrote here for you guys because I know my handwriting is horrible. So in the exam, they'll say, hey, John borrowed $350,000 loan at 4.75 interest rate for 30 years. This property pays 10,800 in annual taxes, and the insurance is roughly 1,350 a year. How much would be their monthly payments? All right. What I do when it's a math question, this is what I do. I extract information and I break it down. So I just extract information because that's all I need to do. Instead of reading the whole thing over and over, I start writing it down. So what do we know as facts? We know that there's a $350,000 loan. We know that the interest rate is 4.75, and we know it's for 25 years. We also know that the taxes are 10,800 per year, and that the insurance is 1,350 per year. What they're asking is, what is the monthly PITI? All right. So I'm going to let you guys do that. Give you roughly 2 minutes to do it because it's not that hard. Just go back to the table. If you want me to put the table on the screen, I will. Ooh, I'm getting different numbers. Go ahead. Everybody must answer this one. Okay. I'm going to trust you guys. I just give random numbers here. So I'm going to do this with you in a second. Completely random numbers. So I have no idea what the answer is. Right? We're going to see in a little bit. So just put your answer over here. 350,000 loan, 475 interest rate, 4.75 interest rates, 25 years. The taxes are 10,800 a year, and the insurance is 1,350 a year. What is the monthly principal, interest, tax, and insurance? Monthly PITI. Kind of gives me two different numbers, okay? Did everybody answer? Is there anybody that didn't answer yet? Good, I got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 15, 16, 17. I got 17, 18 answers right now. 18 answers. There's 32 of you. 19 answers, 20 answers. A question mark is not an answer. All right, 21 answers right now. There's 32 people. I got 21 answers. 22, 23, 24. Just a few more. You can do it. Just a few more answers. 25. It's okay to be wrong. During the class, it's okay to be wrong. In the state exam, that's the problem. But right now, you can be as dead wrong. No problem. Just give it your best shot. That's all I ask for. You don't have to yell at me, Samaya. Like, hold on. Nika's getting nervous. Relax. You getting nervous because you need the break, or are you getting nervous wanting the answer? All right. All right, I'm going to move forward in 5, 4, 3, 2, 1. All right, let's go for the answer. I know somebody said hold on, but gotta move on. So here's the thing. The first thing you got to do is identify what the number is for these two. First thing you got to do. So I'm going to go back here. I'm going to look at 4.75 or 4 3/4. And I said 25 years, right? So that's where it's at. 5.71. We're going to go back here. 5.71. This is the number needed to amortize the loan per month per thousands. If it's per thousands, what number do I need from the loan amount? 350. I divide this by 1,000, and this is the number I get, 350. So 350. That's what we get. 350 times 5.71 is 1998.5. Should I just trust blindly?
You can check this.
This is 1998.5. Now this is the monthly what? Principal and interest. So it does not include the taxes. This is not the number we need. This would be the number we needed if that's what the question was. If the question was, hey, what's the monthly principal and interest? This would be the answer, okay? But I did say what's the monthly PITI, so that means principal and interest, which is this, plus tax and insurance. So our next step, because this is yearly, our next step is to divide these two by 12. So it's 10,800 divided by 12 is what? 900 per month, right? And the other number was 1350 divided by 12. 112.5 per month. For a grand total of 1,000 12 per month. Right? So this right here is the monthly taxes and insurance. What do we have to do next? Final step,
Edit.
put them together. Absolutely. So my screen collaborates and listens. So we're going to go here and we're going to add 101 to 5. So now we got here is monthly TI. And the result of these two is 1998.5. Yep. The result is 3011 PITI with nice colors. Fancy colors, right? Okay. In case you're wondering, I am a lefty. This is how I write. So sorry for going up. You want me to zoom out or zoom in? Zoom in. All right, who got this number now? Okay, some of you did not have this number, so I hope now you understood. Zoraida says, not me. Okay, where did I lose you? Oh, you didn't add the TI, but now you're adding the TI, you're good, right? That's what I'm asking. Now we're good. Those of you that had wrong, now you understand why you had wrong. Good. All right, cool beans. Let's go to the next one. Really? All right, another potential question in the exam. That's the reason why I put this here. Otherwise, I wouldn't even care about this chart and this next statement here. Yes, that was the full payment, PITI. Yep. All right, so another question that might ask in the exam is, what is the first month's interest or last month's interest on a monthly payment? Just the interest. So to calculate the interest on an installment payment, right, you have to follow these steps. Very simple. They can ask one of 4 questions related to this, so I have all the 4 steps here. The amount of interest due on any one installment payment is calculated by computing the total yearly interest based on the unpaid balance and dividing that figure by the number of payments made each year. The following example on an amortized loan of 200,000, so just like the previous one, for 30 years at an annual interest rate of 625 and a monthly payment of 1232. So they're both the same, based on the same numbers, right? The amount due after the first month's payment has been made can be calculated in 4 steps as follows. So if in the exam they're asking you, this is step number 1, if they ask you, what is the annual interest rate? Pure interest rate, very simply calculated, is $200,000 times the 625. And this becomes 12,500 as an annual interest rate. If they ask you that, this is where you stop. Okay. If they ask you what's the first month's interest, well, if the yearly is 12,500, how do we calculate a month? We divide by 12. That would be step number 2. If they ask you what was the first month's interest, and the first month's interest will be 1,041.67. Now we know that the payment every month is 1,232, right? That's what we know of the payment based on the question. What if they're asking you how much of that payment went towards the principal? Well, if the first month's interest is 1,041.67, then we just got to deduct that from the payment. 1,232 minus 1,041.67 is 190 33. That's how much went towards the principal. Crazy, right? $1,200 a month, and not even 200 goes to the principal. But that's your first month. As the years go by, more goes towards the principal, less goes towards the interest. Okay, but this is the first month, 190. So now, after making your very first payment of 1,200, how much do you owe on your mortgage? Because the only thing that reduces the mortgage is the principal payment. We borrowed 200,000, 190 went towards that. After the first payment of 1,200, we only owe 199,809. Right? Woohoo! That's why a lot of people get upset. I pay every year, every month. I pay. 5 years later, I still owe a bunch of money. Yeah, because the first, it's better than the 200,000. Thank you, Zarada. Absolutely. The first 21 years of a fixed rate mortgage, the first 21 years is pretty much interest. The last 9 years of a 30-year fixed rate mortgage is the majority of the payment goes towards the principal. The first 21, interest.
How would you calculate the last?
So the concept will be pretty much the same, but we don't worry about that very much. It gets complicated as the years go by. You need an actual amortization schedule. So for the state exam, it's not calculated at all. Okay, and you can get amortization tables from bankrate.com. So you go to Bankrate, you put whatever it is, and you want to see the amortization schedule, and it'll tell you how much you're paying in the first years, how much you're paying in the final years, and in between. But it usually, like I was saying, around the 21st year, let's say your payment is 1232. So roughly 616 goes towards principal, 616 goes towards interest. Only 21 years later, more or less. Okay, so the first 21, the majority goes towards interest, and then the last 9, the majority goes towards principal.